19% NOI growth. We have an active and accretive acquisition pipeline sourced through our deep relationships in the sector, including $1.8 billion closed since January 1. Our senior housing portfolio will essentially double in size this year, and the number of operating partners will increase from 2 to more than 10. We're on pace to accomplish a 3-year business plan in 12 months. Janus Living's success is also driving earnings growth at Healthpeak, given our unique and creative deal structure that aligns the interests of both companies. I'll turn it to Kelvin.
Thank you, Scott. We continue to execute our plan and have made tremendous progress year to date in our leasing and capital allocation objectives. I'll take a moment on our outpatient medical recapitalization with Brookfield. We're pleased to complete this strategic partnership as the proceeds raised exceed our capital recycling target for the year in a single transaction. With the leadership from our investments team, we've demonstrated our ability to execute scale transactions and partner with leading institutional investment managers. From a structure perspective, Healthpeak will retain a 51% ownership interest in a 5.6 million square foot outpatient medical portfolio and raise $1 billion of cash proceeds. We will utilize our best-in-class platform and expertise to provide asset management, property management, and leasing services, maintaining day-to-day control of the real estate and preserving our client relationships. Economically, the transaction represents a trailing cash cap rate of 5.9%, and after 7 years, we'll have a finite number of call rights to repurchase the non-controlling interest at a price sufficient to provide Brookfield a 6.5% unlevered rate of return. Most importantly, this partnership expands our access to alternative sources of equity capital with a framework we can replicate to pursue growth opportunities across our business. Now turning to the second quarter results. We reported FFO adjusted of 46 cents per share and net debt to EBITDA of 4.7 times. Now starting with outpatient medical, we had another strong quarter of leasing as we continued to see demand for our real estate. For the quarter, we executed 1.2 million square feet of leases, including approximately 327,000 square feet of new leasing, bringing our year-to-date total to 2.3 million square feet. We achieved 80% tenant retention and cash releasing spreads of 5%, which is in line with our average of 5% over the last 10 quarters and above our pre-physicians realty merger averages of 2 to 3%. We ended the quarter with total occupancy up 20 basis points sequentially to 90.7%. Since July 1st, we have an additional 204,000 square feet of lease executions and approximately 882,000 square feet under LOI. I'd like to highlight our partnership with Northside in Atlanta, as it's proven to be a source of strategic growth for our outpatient portfolio. We have now entered into another development agreement for the ground-up construction of a new outpatient medical project to support their expansion in Atlanta, where we have #1 market share. This will be the 5th development project with Northside, totaling approximately 565,000 square feet. Moving to lab, we continue to make progress towards net absorption and total occupancy capture through year-end. For the quarter, we executed 381,000 square feet of leases, of which approximately 60% was new leasing and 30% on vacant space. We ended the quarter with total occupancy increasing by 80 basis points sequentially to 78.5%. That is a 140 basis points increase since year-end 2025. And since July, we've entered into approximately 20,000 square feet of leases and have another 480,000 square feet under LOI. As a result of this activity, we anticipate a modest improvement in total occupancy by year-end from where we stand as of June 30th. These results reflect our focus on driving leasing volumes at our properties, which I would like to highlight by sharing our progress in Torrey Pines, the premier lab submarket in San Diego. The activity we've seen in Torrey is a testament to our team on the ground and our high-quality portfolio, as tenants are seeking core assets and core locations with experienced landlords. This is allowing us to capture an outsized share of the deal volume. When accounting for executed leases and LOIs, our leased percentage in the submarket increases to 97% from approximately 65% at year-end 2025. And ending with senior housing. Healthpeak's ownership interest in Janus Living is now 74%, which represents approximately $6.5 billion of equity value. For the second quarter, Janus Living delivered total revenue growth of 45%, adjusted EBITDA growth of 34%, and ended the period with cash on the balance sheet and no outstanding debt. Now moving to the balance sheet. We had significant activity during the second quarter into the third quarter against a backdrop of elevated borrowing costs. We have taken prudent steps to manage our debt maturities and maintain flexibility in accessing the capital market. Through year end, we now expect to generate $1.9 billion of gross proceeds from capital recycling initiative. And to date, we've completed $1 billion of acquisitions and buybacks. Through August 4th, we have repaid $900 million of debt, including $650 million of senior unsecured notes in July. We ended the second quarter with net debt to adjusted EBITDA of 4.7 times and $4.1 billion of available liquidity. And quickly ending with guidance before we open up for Q&A. We raised our FFO's adjusted guidance range by 2 cents to $1.73 to $1.77 per share. The raise was driven by a 75 basis points increase in total same-store NOI at the midpoint, which includes a 200 basis points increase in both lab and senior housing, and the recognition of the below-market interest amortization related to the $400 million seller note repayment. To recap, we've made significant progress across the business through the first half of the year, and our balance sheet has never been stronger. We have ample capacity available to deploy into new investments as we find opportunities. And with that, operator, please open the line for questions.
We will now begin the question and answer session. To ask a question, you may press star, then 1 on your touch-tone phone. If you are using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star, then 1 again. In the interest of time, callers will be limited to 1 question. At this time, we will pause momentarily to assemble our roster. Your first question is from the line of Ronald Kamdem from Morgan Stanley. Your line is now open. Please go ahead.
Hey, great. Hey, just wanted to ask about the lab portfolio. Looked like occupancy picked up, as you mentioned, sequentially, and still expecting sort of improvement in the back half of the year. I guess I'm just curious, as you're sort of putting it all together with the environment, with the leasing pipeline, when do you think you'll have line of sight to be able to see sort of same store inflect to the positive? Thanks.
Hey, Ron, this is Kelvin. I'll start there. I think what's most important that we've been really focused on is capturing more than our share of the demand in the market and driving net absorption through the portfolio. And we've been able to do that through the first half of the year. We started with 77% occupancy coming into the year, and now we're at 78.5% total occupancy, which I think is a testament to the team doing a really phenomenal job on the ground to capture that demand. And it'll certainly translate. We improved our same-store guidance for lab by 200 basis points at the midpoint, and that's certainly trending in the right direction. That's driven by the improvement in occupancy and just the overall health that we're seeing in the sector. So, I think it's probably a little too soon to predict exactly which quarter we'll see that inflection, but we're certainly trending in the right direction.
Hey, Ron, I just want to add, same store is less relevant. The real key is total occupancy and moving NOI in that segment higher. That's what generates earnings growth and ultimately share price. So that's all we talk about internally. That's the number we're reporting on. We report same store because we have to. That's not the number we focus on. The key is we're growing total occupancy, and that's going to grow total NOI and ultimately earnings. So we're making progress already in the first half of this year. Next question.
Your next question comes from the line of Juan Sanabria from BMO Capital Markets. Your line is now open. Please go ahead.
Hi, good morning, and thanks for the time. I appreciate how succinct the prepared remarks were. Just on the lab and the competitive environment for leasing, you obviously have different players out there with different motivations, highly motivated to push up leasing as you guys are. But just curious if anything has changed with regards to the rate environment, free rent, build-out costs, et cetera, and maybe as part of that, if you can comment on any changes in the size of tenants out there, small, medium, large, and where the improvements have been?
Hey, Juan, this is Kelvin. I'll start there. What I'd say is the pipeline continues to be fairly robust. We've seen since September of 25, strong demand just continue in the portfolio. We've had a 2 million square foot leasing pipeline, and we've been capturing that demand and translating it into executed LOIs and leases. So as of the earnings call, we had 500,000 square feet under LOI, which is within our 2 million square feet of pipeline. And I'd say that the characteristics of that pipeline hasn't changed dramatically. It's disproportionately wet lab space. It's biotech tenants that are really attracted to core assets and core locations. So we're certainly a recipient of all of the positive momentum we've seen in the biotech sector. From a rates and concession standpoint, I'd say that the rates continue to be in line generally with our portfolio averages. Free rent has trended to be 1 month per year up to 2 months per year of lease term. And that's been fairly consistent. So it's really, it's use dependent. It's a condition of the quality of the space, how much capital needs to be invested that's really driving the economics around these deals. And each situation is fairly unique. But most importantly, our portfolio can accommodate a wide variety of uses. And we've seen the benefit of that in our results. We've had fairly low capital deployed to capture that occupancy, just given the quality of our spaces for second generation leases. And in certain instances where we have redevelopments, CapEx could be more elevated as we have to, improve spaces that have been occupied for multiple decades by a single tenant. So I think the pipeline continues to be strong, and the team's doing a phenomenal job converting it.
Hey, Juan, this is Scott Bowen. The only thing I'd add on that too is from a size perspective, we have seen more in that 25 to 75,000 square foot range, both in the executions as well as the LOI and pipeline bucket. So I think that size range is normalizing as we see the funding environment continue to improve.
Your next question is from the line of John Kilichowski from Wells Fargo. Your line is now open. Please go ahead.
Hi, good morning. Scott, in the opening remarks, you talked about the outlook for lab getting more attractive here. I'm curious, are we getting back into an environment where the distressed lab opportunity is looking more attractive to you, and what's the opportunity set today there?
Yeah, the building blocks for the sector recovery are definitely there, and we're starting to translate that into leasing pipeline and leasing execution, growing occupancy. So things are definitely getting better. Obviously, there was some work that needed to be done with vacancy, so it's not going to happen overnight, but the trajectory is clearly positive. I think the incumbents like Healthpeak are definitely capturing market share. So we're focused on core markets, buildings we want to own long term, and particularly situations where we think our platform can bring something to the table and lease up a building that's otherwise not doing very well. So I think we've got the team and the balance sheet and the credibility to do all those things. The pipeline is active. It may end up not doing anything. We'll see. These deals take time to play out. Sometimes they're quite complicated, lenders involved, et cetera. But we're working on a number of situations. We obviously did the one at Gateway over the new year. It's doing phenomenally well. Scott, Natalia, and the team are leasing it up. Signed something like 125,000 feet of leases or LOIs since that purchase, and active discussions on another 200,000 feet or so. So really making good progress on that at a great basis. So hopefully it's situations like that that we're focused on, core submarket in a situation where we can really add value with our platform and balance sheet and relationships. So we're working on a number of them, but no promises that any of them get done. But I think we'll end up being a consolidator over the next 24 months, which should prove to be a great time to grow the portfolio.
Your next question is from the line of Austin Wurschmidt from KeyBanc Capital Markets. Your line is now open. Please go ahead.
Thanks. Good morning, everybody. Kelvin, I think you had said that about 30% of the new leasing in the second quarter was for vacant space. I'm just wondering if you can give us some sense about the difference between leased versus occupied today, and kind of how that's trended, versus last quarter, and what kind of the commencement schedule looks like across those leases that have been signed and are expected to take occupancy, over the next 6 months or so. Thanks.
Yeah, thanks, Austin, for that question. Without giving very specific guidance in terms of occupancy in the forward quarters, what I could simply say is that we have commencements in the back half of the year that exceed our expirations, and we continue to expect a modest improvement in total occupancy for the lab portfolio. We've talked about the pipeline. It continues to be healthy, and these leases have the potential to commence starting in 2026 that are within our LOI bucket. I wouldn't say it's a substantial share of that 500,000 square feet that we mentioned, but we do have the potential for some of our recent executions to benefit 2026 and into